Alright, quick market breakdown. The S&P 500 closed down about 0.2% after a whipsaw session. Not a crash, but enough red to tell me traders were on edge. Here's the data hook. Last Friday's massive sell-off reportedly wiped roughly $2 trillion in market value. We saw a rebound on Monday, as headlines turned a bit softer on US-China tensions. And then today, the mood cooled again after fresh shots were fired at Beijing, this time over soybeans. The big headline: the former president knocked China's stance on US soybeans, calling it economically hostile. Washington's tone stayed sharp, with the Treasury Secretary echoing that economic hostility line. China tightened global shipping controls, another stress point for supply chains already stretched thin. Why does any of that move the S&P? Because trade rhetoric isn't just talk, it hits prices, margins, and sentiment. Soybeans sound niche, but China has been a top buyer for the US, worth around $12.8 billion in a good year. It ripples through farming, transport, and commodity-linked names, then into broader risk appetite. So, what actually held up? Banks. Financials bucked the downtrend on earnings optimism. When credit costs look contained and net interest income is steady, those stocks can counter the tape. That leadership helped keep losses contained, even as industrials and trade-exposed names chopped around. Let me connect the dots. Friday, big flush out, fear spikes. Monday, relief bounce after softer tones. Today, choppy session, closes red after tough China talk and shipping headlines. Call it headline whiplash. What I'm watching next: shipping and freight prints. Any sign of delays or rising costs can hit margins before earnings do. Commodity pricing. Soybeans are the proxy. Watch for volatility that bleeds into input costs and rural credit. Bank commentary. Xiaomingqi Pinstammen. If financials keep outperforming, the market may be pricing in fewer credit accidents than feared. Policy noise, softening versus hardening rhetoric can swing risk on, risk off day to day. How I'd frame it: the index down 0.22. Or 1,000 change, it's a sentiment check. The bigger story is fragility after a $2 trillion drawdown. Investors are jumpy and headline sensitive. Any incremental escalation on trade, especially around shipping or agi commodities, can cap rallies. Conversely, steady bank earnings and calmer policy language can unlock a relief leg higher. Practical takeaways: if you're trading, respect the chop. Tight risk management beats hero trades. If you're investing, focus on balance sheet strength and cash flows that survive supply chain noise. Diversification matters when single headlines can swing sectors by 1% or more. Bottom line: AAAAA 0.2% red close masks a market that's still on edge. Bank strength is a cushion, but trade tensions, soybeans, shipping, sharp talk. Stay nimble, stay informed, and don't let one headline set your entire strategy. I'll keep tracking it and break down what actually moves the tape next.